Welcome to This Explainer. Today, we're unpacking a really fascinating topic, and one that literally affects all of us, the wealth building journey, from absolute beginner all the way to successful investor. The financial industry really loves to overcomplicate wealth building. They throw around dense jargon and all these complex formulas just to make it seem like some sort of exclusive club. But the truth, investing is absolutely one of the most powerful ways you can achieve financial freedom. And its core principles are surprisingly straightforward once you cut through all that noise. So over the next few minutes, we're going to distill things back down to the absolute core. We're bypassing the jargon entirely to show you exactly how to build lasting financial freedom. Let's dive in.
Right off the bat, we've got to ask ourselves a pretty blunt, honest question. Are you trying to get rich quick, or are you trying to build lasting wealth? It sounds like a super simple choice, but honestly, making that mental shift is psychologically incredibly difficult. We're just wired to want immediate results, right? But the data makes it abundantly clear. Successful investing is absolutely not a get-rich-quick scheme. It is a deliberate, multi-decade journey. It takes continuous learning, strict discipline, and smart decision-making over decades, not days. The very second you stop treating the market like a casino and start treating it as a vehicle for long-term ownership, well, that's when everything changes.
All right, let's jump right into Section 1, your investment toolkit.
So the very first step on this journey is understanding the actual tools you have to build your portfolio. The bedrock of investing is balancing the aggressive long-term growth potential of stocks against the more conservative, steady income of bonds. It's that classic tug-of-war between growth and stability. When you buy a stock, you are literally buying a piece of a business. Historically, the stock market has returned an average of around 7 to 10% annually after inflation, and that's driven by capital appreciation and dividends. But, that growth comes with a bumpy ride. Bonds, on the other hand, are essentially loans that you make to a company or a government. They historically offer lower yields, usually hovering in the 3 to 5% range, but they act as the shock absorbers for your portfolio. They give you steady, reliable income with way less volatility.
Okay, so beyond those foundational building blocks, we have alternative assets, and each one offers unique opportunities along with very distinct risks. First up, consider precious metals like gold and silver. For thousands of years, these have been a reliable store of value. When fiat currencies inflate and lose purchasing power, gold historically acts as a powerful hedge to protect your wealth. Then we have real estate. This is still a cornerstone of wealth generation because of its dual benefit. It generates ongoing, tangible rental income while also appreciating in value over the long haul. And finally, cryptocurrencies. This is your classic high-risk, high-reward wild card. It attracts investors with massive growth potential and decentralized tech, but it carries extreme volatility. A crypto asset can easily drop 20% in a single weekend, so it's really only for those of us with a high-risk tolerance.
Look, if analyzing and picking a bunch of individual assets feels like a full-time job that you just don't want, mutual funds and ETFs, exchange-traded funds, are incredibly powerful solutions. These instruments essentially democratize investing. Instead of betting on just one horse, ETFs let you buy a slice of the entire economy with literally a single click. By pooling money from thousands of investors, they automatically give you broad market exposure across hundreds or even thousands of assets. This drastically reduces your individual risk. And honestly, the best part is you don't even need extensive market expertise to use them effectively. Okay, moving right along to Section 2, managing risk and volatility.
Because let's face it, knowing what to buy is really only half the battle. Keeping your wealth secure during market chaos, that's the other half. The ultimate defense mechanism in investing is diversification. Smart investors don't just try to pick one winner. Instead, they build a financial fortress by spreading their capital across different asset classes, diverse industries, and entirely different geographical regions. Think of it like this. If you have all your money tied up in US tech stocks and a massive new regulation hits Silicon Valley, your entire portfolio takes a beating. But if your capital is spread out across European healthcare, Asian real estate, and global bonds, well, you severely reduce your risk. If one sector takes a hit, the others act as a buffer, keeping you safe from a total wipeout.
Now, there is an absolute golden rule in risk management. Never ever invest money that you cannot afford to leave untouched for several years. Seriously, even the absolute best investments are going to experience temporary declines. This brings up the critical concept of liquidity risk. If you actually need that invested cash to pay rent next month, or maybe to fund a wedding next year, a temporary market dip is going to force you to sell your assets at a loss. You end up turning a temporary paper loss into a permanent, actual loss. Your investment capital needs a long runway to weather the storms and actually do the work for you. You also have to remember that your portfolio doesn't exist in a vacuum. It is constantly being battered by global forces, things like interest rate hikes from central banks, creeping inflation, shifting government policies, and just the general ebb and flow of global economic growth. Consider technological innovation for a second. The sudden explosion of artificial intelligence hasn't just boosted tech companies, it has entirely disrupted legacy industries, shifting billions of dollars in market value almost overnight. You really must stay informed about these global events. But here's the secret: maintain a long-term perspective. You want to observe those macro trends, but refuse to react emotionally to the erratic daily market movements they cause.
Let's pivot slightly to Section 3, Education and a Patient Mindset. We've looked at the math and the tools, but now we've got to tackle the human element, the actual psychological mindset you need to navigate these turbulent markets. The most successful investors treat their education as a continuous, never-ending loop of mastery. It means consistently studying how markets work, diving deep into corporate financial reports so you truly understand company fundamentals, and continuously tracking those global shifts we just talked about. The business landscape is always evolving. A company that totally dominated a decade ago might be completely obsolete today. So by committing to lifelong learning, you ensure your investment thesis stays sharp, relevant, and grounded in reality rather than just outdated assumptions.
There's a saying I absolutely love. Patience is often the difference between average and exceptional investors. It sounds incredibly simple, almost like a cliché, but surviving short-term market panic without hitting that sell button takes immense psychological discipline. When the market drops 20% and every news channel is screaming about financial doom, the biological urge to just sell and protect whatever you have left is completely overwhelming. But wealth is typically built through disciplined decision-making over decades, not by panic selling at the bottom. You just have to stay patient.
And that brings us to the really fun part, Section 4, the power of compounding. This is where patience meets time and the pure mathematical magic actually happens. So out of all the tools, the assets, the strategies we've discussed today, what do you think is the single most powerful concept in investing? What is the one thing that truly drives massive generational wealth creation? The answer? It's compound growth. This is simply the process of reinvesting your returns to generate additional returns over time, creating this completely unstoppable snowball effect. Picture a tiny snowball rolling down a really long hill. It picks up more and more snow, growing exponentially larger until it's practically an avalanche. To see how crazy this math gets, and this is based on the rule of 72, consider this surprising fact. If you invest just $100 a month, starting at age 25, assuming an average 8% return, you won't just have the $48,000 you put in by the time you're 65. No way. You will have over $340,000. Your money makes money, and then that new money goes out and makes even more money. It is literally the ultimate financial leverage. To bring this all together, lasting success really requires 5 non-negotiable pillars: knowledge, discipline, diversification, patience, and a long-term mindset. Whether you're buying stocks, securing bonds, investing in real estate, or picking up broad market funds, the goal is exactly the same. You are trying to consistently build a balanced portfolio that aligns with your own personal financial objectives and your unique capacity for risk. You don't have to be perfect, you just need to be persistently consistent with these 5 pillars. We're going to wrap up this explainer by leaving you with one final provocative thought. The journey from beginner to successful investor isn't about outsmarting the market. It's about outlasting it. So ask yourself right now, is your current portfolio built to survive your emotions? Or is it just sitting there waiting for your next panic decision? Real wealth is built quietly, patiently, and deliberately. Thank you so much for joining me on this explainer. And hey, here's to your wealth building journey.